I'm Daniel.
And I'm Mira.
So today, the market just suffered from, extreme whiplash.
Oh, absolutely. It was everywhere.
Right. We had S&P futures surging on this massive wave of artificial intelligence euphoria, while, at the exact same time, military forces were physically blowing out the engines of oil tankers in the Gulf of Oman.
Yeah, it was a high-stakes tug-of-war.
Yeah.
You've got this massive, totally unstoppable tech cycle pulling on one side, and then a rapidly escalating military conflict on the other.
And the bottom line for today, Monday, June 8, 2026, really reflects that absolute chaos.
It really does. Because despite the severe intraday volatility, the S&P 500 managed to close at 7,405.73.
Which is wild.
Right, and the Nasdaq actually closed higher at 25,929.66. And then, strangely enough, crude oil cooled off significantly, even with active physical disruptions happening in the Middle Eastern shipping lanes.
It's a lot to process. So if you are managing a portfolio or, even just trying to understand where the global economy is headed, today is one of those days that absolutely demands a closer look.
Definitely.
So here is the roadmap for today's deep dive. We are going to unpack the massive weekend geopolitical carryover that basically set the table for today's action. Then we will break down the intraday U.S. market moves.
Right, that morning surge and the very aggressive afternoon fade.
Exactly. We'll also cover some massive corporate pivots from Apple and Nvidia, and finally wrap things up with our live paper trading segment.
And before we dive into the details, just a quick mandatory reminder. This deep dive is strictly for market context and discussion. It is not personal investment advice or an investment recommendation.
Perfect. So let's get right into it. Session 1, what set the stage before the U.S. session?
Well, the geopolitical backdrop deteriorated really rapidly over the weekend. Specifically on Sunday, June 7, Israel launched a targeted military strike on Beirut's southern suburbs. Yeah. And in immediate retaliation, Iran fired approximately 30 ballistic missiles directly at Israeli territory.
We have talked before on this show about geopolitical escalation as brinkmanship leverage, and this was a textbook display of that.
Completely textbook. Both sides drastically raised the stakes, essentially maximizing their military leverage ahead of any potential diplomatic talks.
Which brings us to the diplomatic intervention, right? Because former U.S. President Trump stepped in directly on Sunday, publicly pressuring both Israel and Iran to pause their strikes.
Right. He even claimed that a final comprehensive deal is very close.
But, if you look at the physical reality on the ground, or I guess rather on the water, the naval blockade in the Strait of Hormuz remains fully active.
Which heavily impacted the macroeconomic reality before the opening bell even rang. Because while those missiles were flying, OPEC Plus was actively meeting.
Talk about crazy timing. Seriously. And they made the calculated decision to keep their group-wide output policy steady over the weekend. Though 7 specific nations did agree to adjust their quotas slightly upward for July.
Okay, so a slight adjustment.
Yeah. But meanwhile, Fitch Ratings stepped in and cut its global sovereign outlook. They explicitly warned that this conflict with Iran is going to weaken global GDP growth and raise inflation.
Through, a combination of more expensive energy imports and higher borrowing costs.
Yeah,
right?
silly.
Let's look at this through a game theoretic lens for a moment, Mira.
Yeah.
Because I really have to push back on the neat little de-escalation narrative the market initially digested this morning.
Go for it.
Does a political intervention actually solve a physical shipping blockade?
Oh, well.
Because if Trump brokers a pause in the missile strikes, but the Strait of Hormuz is still choked off, the underlying economic friction hasn't changed at all.
Right. Ships still have to reroute. Insurance premiums still skyrocket. Exactly. It feels like this is just, a temporary ceasefire that kicks the can down the road, allowing both militaries to simply rearm and reposition.
I completely agree. A diplomatic pause is absolutely not the same as physical normalization.
Not at all.
The market was just trading on the immediate relief of avoiding a full-scale regional war over the weekend. But you are entirely right. The structural supply chain choke points remain unresolved.
And while all of this geopolitical tension was brewing, the technology sector was busy setting up a completely different stage over the weekend.
Right, because Apollo Global Management and Blackstone finalized a staggering $35 billion in debt financing for Anthropic.
$35 billion.
Yeah. If you are wondering how these artificial intelligence companies are paying for all this infrastructure, well, this is your answer.
$35 billion in private credit is just, it's an astronomical figure. It proves that this mega capex serves as a market fragility mask.
Definitely. We are seeing these massive infrastructure builds advancing beyond just the public hyperscalers like Amazon and Google and moving deep into external private market financing.
Let's break down why that matters to you as a listener. When a company like Anthropic bypasses public equity markets and goes straight to private equity giants like Apollo and Blackstone for debt financing, they're effectively shielding themselves from public market volatility.
Right. They don't have to worry about their stock price tanking on a bad Tuesday.
Exactly. They have locked in billions to keep buying chips and building data centers. It creates a structural momentum that acts as a floor for the entire tech sector, even when the broader macroeconomic environment looks incredibly unstable.
So to wrap up this first part, the table was essentially set with intense geopolitical anxiety on one side and this unyielding tech investment on the other.
Spot on. We're going to take a very short break, and then we'll transition into how the U.S. trading hours actually digested all this.
Sounds good.
All right, we are back.
Session 2. What moved markets during U.S. trading hours?
Well, if you were watching a brokerage account today, it was a total roller coaster. S&P 500 futures surged to 7,473.25 right around 10 a.m. Eastern time.
But they couldn't hold it.
No, not at all. The market aggressively faded in the afternoon, dragging the cash session close down to that 7,405.73 level.
And Nasdaq futures were even more erratic. They spiked over 29,670 intraday before completely surrendering over 200 points.
We constantly remind ourselves on this deep dive that discount rates act as financial gravity.
Always.
With the 10-year Treasury yield stubbornly hovering near 4.55%, equities simply struggle to maintain those intraday highs.
Right, because high interest rates actively pull down the future value of a company's earnings. So no matter how much AI euphoria is pumping through the market, a 4.55% risk-free rate exerts a gravitational pull that makes, premium valuations incredibly difficult to sustain.
And that gravity was heavily reinforced by the economic data we received. At 11 a.m. Eastern Time, the New York Fed released its consumer survey.
Which was really interesting.
Yeah. Now, on the surface, there was a silver lining. One-year consumer inflation expectations actually ticked down slightly to 3.5%.
But that was accompanied by a deeply mixed labor outlook.
Exactly. If you are looking at your own household budget right now, balancing your grocery bills against your job security, you are feeling exactly what the New York Fed is measuring. Consumers are reporting increased chances of job loss while simultaneously anticipating a higher quit rate.
That divergence complicates the Federal Reserve's path forward immensely.
It really does.
It paints a picture of a consumer base that is still feeling the localized pinch of inflation, but is now becoming highly anxious about employment stability. It's the whisper of stagflation.
Yeah, that's a scary word.
But, the most staggering divergence today wasn't in the labor data. It was in the energy markets.
The oil disconnect. This was the wildest part of the day. Crude oil faded from an early high of $95.47 all the way down to close at $91.30.
Which is crazy.
Right. It seems like algorithmic traders and energy markets collectively decided to just price in Trump's ceasefire headlines and ignore everything else.
But I have to jump in here, Daniel, because the reality on the water tells a completely different story.
Tell me about it.
At exactly 12:01 p.m. Eastern Time today, U.S. forces literally fired a munition into the engine and steering compartments of an empty Pala-flagged oil tanker.
The Marivex.
Yes, the Marivex, right in the Gulf of Oman. They intentionally disabled it for violating the ongoing naval blockade against Iran.
Let that sink in for a second. While oil futures are dropping on diplomatic optimism, the U.S. military is actively blowing out the engines of commercial tankers trying to run a blockade.
We often say markets are pricing ahead of physical reality, but this is an extreme manifestation of that behavior.
Extreme is the word.
Traders are pricing in the political headlines of a ceasefire, while completely blinding themselves to the kinetic military enforcement happening in the ocean right now. The blockade is being violently enforced, yet crude oil closed down for the session.
It really is a massive blind spot. So, to summarize, we had this early equity surge get dragged back down to earth by the financial gravity of high interest rates, while energy markets ignored active military engagements to price in a diplomatic pause.
Yep, that's the summary.
Let's take a quick break here, and then we will dive into the corporate side of things. are back. Session 3, corporate events recap and what to watch next.
Let's start with Nvidia, because their Sunday and Monday activities were sweeping. CEO Jensen Huang was in Seoul, South Korea.
Making moves.
Big moves. He solidified multi-year agreements with SK Hynix for advanced memory chips. But more interestingly, he partnered with SK Telecom for a gigawatt-scale AI cloud.
Wow.
And he even brought in Doosan to collaborate on robotics and energy solutions.
A gigawatt-scale AI cloud. When you hear the word gigawatt, you should realize we are talking about enough electricity to power roughly 750,000 homes.
It's massive.
Yeah. The fact that a single telecom company needs that level of power just for an AI cloud proves that AI capex is a cycle-agnostic arms race. These companies are building out infrastructure regardless of what the 10-year Treasury yield is doing.
Yeah, they don't care.
But it also highlights the physical ceiling of this technology. Power access is the AI bottleneck. You cannot run a gigawatt-scale data center without securing massive, dedicated power generation.
Which explains the broader industrial partnerships with companies like Doosan. And speaking of the AI race, Apple made its long-awaited move today.
Finally.
At 1:04 p.m. Eastern Time, they kicked off their WWDC keynote. They unveiled macOS 27, Golden Gate, iOS 27, and most importantly, their new Siri AI features.
Right.
But the architectural strategy is what matters here. They announced private cloud computing partnerships with Google Cloud and Nvidia.
Let's explain how this hybrid AI actually works. Apple is essentially saying that simple queries will stay on your iPhone, which saves Apple a fortune in compute costs.
Smart move.
Right. But complex queries, things your phone's chip can't handle, will get securely bumped up to Google and Nvidia servers.
Which is a huge admission that even a giant like Apple needs to rely on the broader hyperscaler ecosystem for heavy compute.
Exactly. But the detail that really changes the game for Apple's global strategy was their admission regarding regulation. They explicitly noted that regulatory hurdles are going to delay the rollout of these new Siri AI tools in both the European Union and China.
That is a devastating headwind. We're talking about two of their most critical international markets.
Massive markets.
The European Union has strict open market regulations, and China has stringent data sovereignty laws.
Wait, so if Apple cannot deploy Apple Intelligence in Europe or China because of these regulatory hurdles, does that mean they are essentially going to be selling a fundamentally inferior iPhone to half the globe?
Temporarily, yes. It shows how global regulatory fragmentation is starting to physically impact the deployment and monetization of this technology. Apple's unified global product strategy is fracturing under regional laws.
And supply chain diversification isn't just an Apple problem. We saw reports today that Google is ordering 3 million backup tensor processing units, or TPUs, from Intel.
Let's quickly define that. A TPU is a custom-built chip designed specifically for the intense mathematical processing required by neural networks, as opposed to a standard graphics processing unit, or GPU.
Right.
Google ordering these from Intel is a pure supply chain safety net. It reduces their singular reliance on Nvidia, mitigating the risk of a single point of failure in their hardware pipeline.
And geopolitics is bleeding directly into the corporate space, too. Right in the middle of the trading day at 12:33 p.m. Eastern Time, the Pentagon officially added major Chinese firms like Alibaba, Baidu, and BYD to its list of Chinese military companies operating in the U.S.
That is a formal designation that dramatically increases regulatory overhang and restricts certain U.S. engagements with these megacaps.
The convergence of all these themes today was perfectly captured by a note in our source document. I'll read it directly.
Let's hear it.
If your portfolio feels like it has whiplash today, don't worry. We started the morning pricing in a full-scale regional war and ended the afternoon wondering if Apple's new Siri can just negotiate the peace treaties for us. At least the tech sector is celebrating, as Nvidia's CEO seems to be partnering with everyone in South Korea except the K-pop bands. Grab a drink, turn off the geopolitical headlines, and just be thankful your assets aren't floating on a disabled oil tanker in the Gulf of Oman.
Honestly, that sums up the psychological exhaustion of the market perfectly.
It really does. So, looking ahead to tomorrow, Tuesday, June 9, here is what is on the radar. We have Fed Governor Barr and Vice Chair Bowman both speaking, which will be heavily scrutinized given today's mixed consumer inflation expectations.
Definitely.
At 10 a.m. Eastern Time, the NFIB Business Optimism Index drops. Then at 12:30 p.m. Eastern Time, we get the U.S. trade balance covering exports and imports.
And we will also see some Treasury bill auctions and the EIA short-term energy outlook later in the afternoon.